Let's talk about stable coins and stablecoin transactions. This past summer, Congress passed a bill regulating stable coins and making them allowable. And what those are is you put $1 in and you get a token out. And you can reverse that. You can put a token in and get $1 out. It's pegged to the dollar. It's always going to maintain that ratio. The company offering the stablecoin takes your dollar and they invest it in U.S. treasuries. And they make interest off those treasuries, which allow them to fund their operations, pay their people, and make a profit. You, in turn, get predictability within the digital asset space. You don't get the huge volatility that you get if you were buying cryptocurrencies or something of that sort. Still using digital, ledgers and or distributed ledgers, pardon me, and blockchain technology. It's one of these things that the banks and credit card companies pushed for because it reduces friction within transactions. It reduces friction within the banking space. The banks are going to use this for interbank transfers, replacing wire transfers and things like that. So in the past, where it would take, say, 3 days or something to verify a transaction, or where they would have to lump a bunch of transactions together and then process them at once, now you can process transactions in seconds using the exchanges and using digital assets, and stable coins and cryptocurrencies reside in the digital asset space. They get traded on the exchanges. And so the idea here for the credit card companies is, if you're buying a product through an online retailer at an online store and you go to check out, if you have a digital wallet or a hardware wallet and you have cryptocurrency, you can pay at time of checkout using that cryptocurrency. And I don't fully understand the mechanics of that. I believe it's one of those things where you're paying the credit card company with your crypto, and they in turn are paying the retailer in dollars. I believe that's how that's actually physically taking place. And of course, then the credit card company is redeeming your crypto on the exchanges for dollars so that they get paid. I believe that's what's happening. But the credit card companies, they make their money off of you carrying a balance on your card, and then they charge you interest. They don't really make their money off of the payment processing fees charged to retailers, because by the time they give you perks and credit card points and airline miles or different things, it's kind of a wash for them. Where their real money is in charging high interest on people carrying a balance. And ultimately, that's where they want to head. They want to get to the point where you may not even have a crypto wallet. You may not even have crypto. You just want to check out, and they use stable coins to complete that transaction. Perhaps the retailer will take stable coins. Perhaps the credit card company has purchased stable coins and they just convert those to dollars and pay the retailer that way, and then you get billed at the end of the month. So increasingly, transactions are going to be taking place in the digital asset space. Whether you want to keep digital assets at arm's length or not, they'll increasingly be taking place using that platform, using that technology. And right now, you're already conducting digital transactions. It just doesn't mean they're in the digital asset space. When you swipe your debit card, you've conducted a digital transaction, but the move is going to be more toward the digital asset space and using exchanges and using stable coins, and that's more of where things are headed. So when I say, the government could have a significant amount of control over who could buy and who can sell, that's why I make that claim. And you can say, yeah, but that's a ways out. It may be, but with a lot of legislation, particularly the Market Structures Bill, it takes years if you decide you want to change it. So if you really want to influence that, now's a good time to do that. People say, yeah, but this stuff's all going to blow away with the wind anyway, because this is just a funny money. It's monopoly money. It's not trustworthy. I get what you're saying. One of the things, though, is you can argue that for the dollar currently anyway, with how it's manipulated through monetary policy at the Federal Reserve or fiscal policy with the U.S. government, and how that affects inflation and how that affects your personal purchasing power. And there's an argument to be made that the U.S. dollar is kind of funny money in some ways. Now, granted, I'm not saying we're getting away from the dollar. I fully acknowledge that stablecoins are denominated in the dollar. That's not what I'm saying. I'm just kind of throwing that out there for you to think about. And also, they're hoping that they'll get rid of a lot of the volatility by doing stablecoins and increasing trust. There's other parts to the digital asset space, though, besides just stablecoins.